$42 billion left one bank in less than 24 hours. Not because of fraud, not because of a cyber attack, because a few thousand people read something on Twitter, opened their banking app, and hit transfer. That is how Silicon Valley Bank died in March of 2023. And here's a number the FDIC does not put on a billboard. At the moment that bank failed, the entire deposit insurance fund held enough money to cover roughly $1.28 for every $100 of deposits it was legally supposed to protect. Not $100, $1.28. That ratio has improved since then. It is now $1.42. I will let you decide if that changes your weekend plans. So the real question is not whether the FDIC could run out. The question is, what happens the morning after? And the answer involves a chain of legal mechanisms, political calculations, and bureaucratic backstops that most people have never read, mostly because those documents are not designed to be found. Here's exactly what I'm going to walk you through. The FDIC is not a vault. It is a coverage ratio, a borrowing facility, and a congressional phone call. Those three things are very different tools when a crisis is moving faster than the people who are supposed to manage it. I want to show you how the math actually works, what happened the 2 times the fund already ran dry, what the legal escalation chain looks like when it blows past the fund balance, and what you specifically need to do about any of it. Because there are 3 moves that cost you nothing and eliminate the most dangerous failure mode. I will give you all 3 at the end. Here's the metaphor I am going to use throughout this video, because it is almost too accurate to be comfortable. The FDIC is a fire insurance company for your neighborhood. They collect premiums from every house every month. They keep a reserve, enough to handle an occasional house fire, maybe 2 or 3 simultaneously. Right now, the reserve covers $1.42 of every $100 in property value they insure. Your neighbor's house catches fire, no problem. 2 houses on the same block, no problem. But if your entire street catches fire on the same Tuesday afternoon, the insurance company starts running on fumes before the fire trucks leave. And then they go to their credit line. And after the credit line, they knock on the Treasury's door. This is not my interpretation. This is the documented escalation chain inside the Federal Deposit Insurance Act, word for word. I am going to call this the coverage ratio problem. Hold that phrase. Every revelation in this video runs through it. In a few minutes, I will tell you about a legal mechanism that was used in 2023 to rewrite the rules of deposit insurance in real time while markets were closed and most people were sleeping. But first, here is why the baseline math should concern you even on a calm Tuesday. The Deposit Insurance Fund, as of the 4th quarter of 2025, held $153.9 billion. That is the official FDIC number. The FDIC insures over $10 trillion in deposits. 10 trillion. The coverage ratio is 1.42%. Their own internal target, the number they have been trying to reach since 2020, the number they consider the minimum sufficient to survive a crisis of the magnitude of the 2008 collapse, is 2%. They are not at their target. And their target, per their own documented analysis using historical data from 1950 through 2010, is the floor of what they would need to maintain a positive fund balance through a repeat of the worst crisis they have ever faced. In other words, the FDIC right now, by their own math, is underfunded relative to what they need to survive the last crisis. Not the next one, the last one. Now add the number they never put in the headline. About 43% of all bank deposits in the United States are uninsured. That comes from the Federal Reserve Bank of St. Louis, published in April of 2026. In raw dollars, as of the 2nd quarter of 2025, total uninsured deposits equaled approximately $9 trillion. Insured deposits equaled $11 trillion. The coverage ratio of 1.42% applies to the $11 trillion. The $9 trillion is sitting there with no FDIC protection at all, legally speaking. Most of the people holding it believe otherwise. JP Morgan Chase alone holds over $1.2 trillion in estimated uninsured deposits. One bank. That single number is roughly 8 times the entire deposit insurance fund. You think the coverage ratio problem is that the FDIC might not have enough to cover insured depositors? Actually, the coverage ratio problem is that the FDIC is being asked to informally backstop $9 trillion of deposits that are above the legal limit using a fund that covers 1.42% of the 11 trillion that are actually inside the limit. There's a man I want to tell you about. He ran a small manufacturing operation out of Phoenix, 12 employees, nothing exotic, mostly commercial HVAC components. His business checking account routinely held between $350,000 and $400,000 because he had quarterly payroll cycles, material invoices coming in, and a 60-day receivables lag that meant he was always holding a float of cash. He had the sticker on the door, FDIC insured, member bank, the whole thing. He assumed he was covered. $250,000 was covered. The remaining $130,000? He was an unsecured creditor of the bank the moment it closed, with the same legal standing as a vendor who never got paid. He just did not know it until I explained it to him. The gap between what people believe the FDIC covers and what it actually covers is not a footnote problem. It is a financial planning problem, and it scales with how much money you have. The FDIC's own problem bank list, as of the second quarter of 2025, contained 59 institutions, banks with what the FDIC calls significant financial, operational, or management weaknesses that threaten their continued viability. The FDIC says that is the healthiest the list has looked since 2022. 2 banks have already failed so far in 2026. I am not suggesting the system is collapsing. I am telling you that 59 banks are on a watch list that the public cannot see, with a fund that holds 1.42% of what it protects. Stay with me, because this next part changes everything. In a few minutes, I am going to show you exactly how the government rewrote the rules in real time during the 2023 crisis, using a legal exception most people have never heard of. But first, I need to establish something that has been quietly deleted from the popular understanding of the FDIC. The fund has gone negative before. Not theoretically, literally, twice. The first time was 1991. The savings and loan crisis had been grinding through the economy for the better part of a decade. The FDIC fund peaked at just over $18 billion in 1987. Then came a wave of commercial bank failures that compounded on top of the broader thrift disaster. The fund's balance sank below zero on an accounting basis to negative $6.9 billion. The fund that was supposed to guarantee your deposits was in the red. Congress quietly restructured the approach, the FDIC borrowed through the Federal Financing Bank, and depositors never lost a penny. But the fund was gone. On the thrift side, the picture was even more dramatic. The Federal Savings and Loan Insurance Corporation, the FSLIC, which insures savings and loans the way the FDIC insures commercial banks, was reported to be at negative $75 billion by 1988, insolvent. The entire agency ceased to exist. The Resolution Trust Corporation was created to clean up the wreckage. The RTC closed 747 savings and loans with assets of over $407 billion. The ultimate cost to taxpayers was estimated as high as $124 billion, with the direct confirmed cost landing at that same number by 2004. The FSLIC's obligations were folded into the FDIC because there was nothing left of the FSLIC to fold. The second time the fund ran dry was 2008 through 2009. From 2008 through 2017, 528 member institutions failed. The annual number peaked at 157 failures in 2010. The insurance fund was exhausted by late 2029. The FDIC demanded 3 years of advanced premiums from its member institutions and ran the fund with a negative net balance under accrual accounting, negative $20.9 billion. At the end of 2009, here's the detail almost nobody mentions about that episode. The FDIC had a credit line available. They could have drawn it. They chose not to, specifically because of optics. An FDIC director explained this in 2013 in plain language. Drawing on a Treasury borrowing line would have been perceived as a bailout, even though the borrowing would have been repaid with interest. So instead of using the legal mechanism available to them, they squeezed advance premiums from banks that were already fragile and ran the protection fund negative. Political performance dressed up as prudent management, that is the coverage ratio problem manifesting in real time. The backup plan is not automatic. It requires a political decision. And political decisions during financial crises are made under enormous pressure, with enormous incentives to avoid the thing that looks like a bailout, even if it technically is not one. By the way, hit subscribe if you like this content. Otherwise, YouTube's algorithm may never show you my videos again. Now, here is why 2023 is a different and more structurally interesting story than either of those two precedents. And it involves a legal exception buried in the Federal Deposit Insurance Act that, when invoked, effectively rewrites the coverage rules in the middle of a crisis. But I want to set up a subplot first, because it's the thing that changed the underlying physics of how all of this works. I'm going to come back to it. In March of 2023, a researcher using the word undercapitalized on social media, combined with a coordinated VC group chat, helped trigger one of the fastest bank runs in American financial history. $42 billion in withdrawal requests hit Silicon Valley Bank in a single day. The bank had $172 billion in deposit liabilities, and 89% of them were above the FDIC limit. When news spread that the bank had unrealized losses on its bond portfolio, the people with uninsured deposits, who had every rational incentive to leave first, left first. Within 48 hours, the contagion hit 22 other banks simultaneously, documented by researchers using high-frequency payment data. The FDIC was designed in 1933. Twitter launched in 2006. The FDIC's crisis response framework was built around the assumption that a bank run looks like a line of people outside a branch. It now looks like a group chat. That is the speed problem. It is the subplot threading through everything else. Now, the systemic risk exception. When SVB failed on a Friday in March 2023, the FDIC, the Federal Reserve, and the Treasury Secretary jointly invoked a provision in the Federal Deposit Insurance Act that allows them to override the standard cost minimization rules. Under normal circumstances, the FDIC resolves a failed bank in the cheapest way possible. Find an acquirer, transfer insured deposits, let uninsured depositors take their chances with the asset recovery process. That is the law. That is the default. The systemic risk exception says, if you believe that following the default process would cause serious adverse effects on economic conditions or financial stability, you can override it and protect everyone, insured and uninsured alike, no limit, the entire deposit book. At SVB, invoking that exception cost the Deposit Insurance Fund an estimated $20 billion. $18 billion of that went to covering deposits that were legally above the insurance limit, deposits that by statute the FDIC was never supposed to protect. The FDIC then issued a special assessment on 114 large banks to recover that cost. Banks that had nothing to do with the failure of SVB paid for the depositors of SVB. This creates what I think is the most under-discussed dynamic in American deposit insurance. If the systemic risk exception is invoked every time a large bank fails, and recent precedent strongly suggests it is, then the effective coverage of the FDIC is not $250,000 per depositor. It is unlimited for banks large enough to create contagion risk. The $250,000 limit is a floor for small depositors and a negotiation point for everyone else. Former FDIC Chair Sheila Bair called this out directly after SVB. She argued that invoking systemic risk for a bank that represented less than 2% of the total banking system created terrible precedent. She was not wrong, which means the coverage ratio problem is substantially worse than the headline number suggests. The fund holds 1.42% of insured deposits. But the fund is also being informally expected to cover a portion of $9 trillion in uninsured deposits whenever the systemic risk exception gets triggered. The actual ratio of fund to realistic exposure, if you include the expected coverage of uninsured depositors at large institutions, is a number the FDIC does not publish. And I understand why. Let me give you a concrete scenario, because this is where it stops being abstract. Say you are a business owner Your company checking account holds $380,000 this week. Large job, just got paid. Payroll hits in 10 days. $250,000 is insured. The remaining $130,000 is yours in the same sense that a bus ticket is yours after the bus leaves without you. The bank is acquired over a weekend by a healthy competitor. In the most common outcome, you never notice. Log in Monday, same balance, different routing number, everything is fine. This is what happened in the vast majority of the 528 bank failures between 2008 and 2017. Quiet, efficient, invisible to the depositor. But in the scenario where no acquirer steps up, which is exactly what happened with SVB, which required a bridge bank and 16 days of limbo before First Citizens bank shares took it over. Here is what happens to your $130,000. You become an unsecured creditor. You file a claim with the FDIC receiver. The FDIC liquidates the bank's assets over time. The recovery rate depends entirely on the quality of those assets. When IndyMac failed in 2008, uninsured depositors recovered 50 cents on the dollar. When Washington Mutual failed in the same year and was acquired by JP Morgan Chase, uninsured depositors recovered everything because the acquirer took on all deposits. The variance between those two outcomes is enormous and nearly impossible to predict in advance. Here is the real failure mode, though. It is not the permanent loss of funds. Permanent losses are rare. It is the temporary illiquidity of funds at the exact moment you need them most. Your insured $250,000 arrives within a few business days, sometimes the next morning. The $130,000 goes into a legal queue. Payroll still hits in 10 days. You breach payroll obligations on day 11. State labor boards are not interested in your FDIC receivership timeline. Vendors start pulling credit lines. The business you built over 12 years begins to unwind, not because your money disappeared, but because it became legally unavailable for long enough to trigger a cascade of operational failures that permanent money cannot undo. This is why I am genuinely obsessive about the structure of cash management. Not because bank runs are likely on any given Tuesday, but because the failure mode is asymmetric. The upside of having your cash correctly structured is zero additional return. The downside of having it incorrectly structured is a liquidity crisis that hits your most important obligations at the worst possible moment. Here is what actually happens when the fund runs out, legally and sequentially. I want to close this loop before I give you the practical framework. The FDIC has a $100 billion line of credit with the US Treasury. This line has never been directly drawn, not once in FDIC history. The FDIC has a separate $100 billion facility with the Treasury's Federal Financing Bank, which it used during the savings and loan cleanup, borrowing $15 billion in the early 90s and repaying it by 1993. And in 2023, the FDIC borrowed $93.3 billion across 5 notes through the Federal Financing Bank, associated with the resolution of the spring 2023 bank failures, $93.3 billion, against a fund that, at the start of that episode, held about $128 billion. 3 large bank failures, $93 billion in emergency borrowing, 3 failures out of 4,000 plus institutions. If the borrowing capacity is overwhelmed, the law allows it to be expanded. During the 2009 financial crisis window, Congress temporarily authorized the Treasury Secretary to increase FDIC borrowing authority to $500 billion with the approval of the Federal Reserve Board and the President. This is the actual backstop, not the fund. The backstop is the government's ability to write a large check and then figure out who gets taxed or assessed to pay it back. Full faith and credit is not a pledge that money exists. It is a pledge that money will be created or collected if it does not. But this is where the speed problem becomes the critical variable. The fund running out is not a moment. It is a process. Between the moment the fund is exhausted and the moment the Treasury backstop arrives, there is bureaucracy, there are conversations, there are political calculations, there are the same optics-driven hesitations that stopped the FDIC from drawing the Treasury line in 2009. During that interval, the news cycle is running. Social media is running. Digital banking is running. The bank runs that caused the fund to deplete in the first place are accelerating because the thing that stops bank runs is confidence. And confidence depends on a credible announcement that everything is fine. That announcement has to come from a credible institution with a credible fund. And a credible fund, by the FDIC's own analysis, requires a 2% reserve ratio. The current ratio is 1.42%. This is the thing that makes the coverage ratio problem not just a math problem. It is a confidence problem. The fund does not need to be zero for confidence to crack. It needs to be perceived as insufficient. And the perception of insufficiency can arrive before the reality does. Here's what I find genuinely fascinating about this, in a mildly dark way. The FDIC's entire communication strategy is calibrated to prevent people from thinking about what I just described. Not because it is a secret, because thinking about it causes the exact problem the FDIC exists to prevent. The confidence in deposit insurance depends on most depositors never seriously questioning whether deposit insurance is adequate. The moment you question it seriously, you might move your money. And if enough people move their money simultaneously, the FDIC's job becomes impossible regardless of what the fund holds. This is not a conspiracy. It is incentive design. The FDIC is an institution with a mandate to maintain financial stability. And maintaining financial stability means minimizing public anxiety about financial stability. The information that would cause the most anxiety, the coverage ratio, the conditional nature of uninsured deposit protection, the political calculations embedded in every crisis decision, is technically public. It is buried in quarterly banking profiles, Federal Register notices, and FDIC staff memoranda. I read those documents so you don't have to. That is literally the job description I gave myself 10 years ago when I started running my own business, surrounded by accountants and fiscal lawyers who taught me how money actually flows. Here's the framework in 3 levels, because it structures the risk in a way that is actually useful. Level 1, one bank fails. The FDIC has reserves, finds an acquirer over a weekend, and the whole thing disappears from public consciousness before it becomes a story. This is the most common outcome in banking history. 528 failures between 2008 and 2017. Most of them resolved this way. Level 2, multiple large banks fail simultaneously, or one very large bank fails with heavy uninsured deposits. The systemic risk exception is invoked. Emergency borrowing is activated. There is a window of 48 to 72 hours where uncertainty is the operative condition. Most people with accounts over $250,000 are in a gray zone during that window. The vast majority eventually get made whole, but eventually can cost you your business, your payroll, your operational continuity. Level 3, the systemic scenario. Multiple, simultaneous, large failures. Borrowing capacity strained. Political hesitation. The confidence gap. This is not the base case for any given Tuesday in 2026. The FDIC's numbers look fine. The problem bank list is at its lowest since 2022. But level 3 is what the coverage ratio problem is a slow motion warning about. Not an imminent crisis, a structural condition. And structural conditions do not announce themselves before they arrive. Here is where the knowing this and building a system around it are 2 very different things. Knowing the coverage ratio is 1.42% is intellectually interesting. Knowing that the systemic risk exception has been used to cover $90 billion of uninsured deposits at 3 banks is structurally significant. But neither piece of knowledge changes your financial outcome unless you actually restructure where your cash sits. I built a digital book called The Exit Code because I kept seeing people who understood all of this. The coverage gaps, the systemic risks, the sequence of returns vulnerability, and still hadn't built the practical framework around it. The Exit Code is 8 chapters built on 50 years of actual retirement data. 2 of the pieces most directly relevant to what we just talked about are the 58% rule, the documented finding that more than half of early retirement failures trace back not to market crashes, but to a forced liquidity disruption during the accumulation phase, exactly the kind of thing a banking crisis creates. and the dynamic withdrawal method, which replaces the standard 4% rule with something that accounts for volatility and disruption rather than assuming a linear, stable world. Your financial advisor charges 1% of your assets annually to explain roughly half of this. The exit code is available through the link in the description for less than a single dinner out. Every year you delay building the framework, the compounding math moves against you, and that math doesn't care about your intentions. Now, the speed problem and the coverage ratio problem need to be resolved together because that's where the practical exposure lives. The FDIC's crisis response depends on its ability to execute over a weekend. Find a buyer, transfer deposits, open Monday like nothing happened. When SVB collapsed in March of 2023, the FDIC had to run a bridge bank for 16 days. During those 16 days, the contagion was already running. Signature Bank failed 2 days after SVB. The KBW Bank Index fell over 20% in a week. 22 banks showed run-like deposit outflows, documented in high-frequency payment data. The contagion spread because the uncertainty spread. And the uncertainty spread in hours, not days, because social media and digital banking removed the friction that used to slow bank runs to a manageable pace. The friction that slowed old bank runs was physical. People had to drive to a branch, wait in line. The line itself was a signal to other depositors. You could see how many people were panicking. Modern digital banking eliminated the visible queue. You make your move in private, silently, on your phone, before anyone else knows you moved. By the time the signal becomes visible, the run has already happened. This is what the academic literature on the 2023 crisis describes as the coordination problem. Beliefs can synchronize faster than regulators can act. Apply that dynamic to a scenario where the fund is closer to the edge, where the systemic risk exception has already been invoked multiple times, where the political will to authorize emergency treasury borrowing is slower to materialize. The gap between the fund is exhausted and the treasury backstop arrives is not a fixed number of hours. It is a political and institutional process. And in that gap, the second and third order effects, the contagion, the depositor behavior, the credit market reactions, can compound faster than any bureaucracy can respond. This is not apocalypse theory. This is the structure of the risk as it actually exists, built from the FDIC's own data and historical record. Here is the practical framework. 3 moves specific to this topic. First, use ownership categories aggressively, not passively. The FDIC insures $250,000 per depositor, per insured bank, per ownership category. Individual accounts are one category. Joint accounts are another. Revocable trust accounts provide coverage of $250,000 per unique beneficiary. A couple with individual accounts, a joint account, and a revocable trust with their adult children as beneficiaries can have coverage well in excess of $1 million at a single institution, entirely within the legal structure of FDIC insurance. Most people with significant cash balances have never had this conversation with anyone because nobody in the financial services industry is paid to have it with them. Your bank is incentivized to hold your deposits, not to restructure your account categories to maximize your coverage. Your financial advisor is paid on assets under management, not cash positions. This is a gap in the incentive structure that you have to close yourself. Second, separate your operational cash from your reserve cash and treat them differently. Operational cash is what you need to meet obligations in the next 30 to 60 days. Payroll, invoices, rent, whatever your version of those things is. This should sit fully insured at a large institution with strong liquidity metrics. Reserve cash is what you hold beyond the operational buffer. This can live in Treasury securities purchased directly through Treasury Direct, in money market funds holding exclusively Treasury obligations, or structured across multiple insured institutions if liquidity matters. Treasury Direct accounts are not bank deposits. They are direct obligations of the U.S. government. The FDIC's fund and its coverage ratio problem are entirely irrelevant to them. Third, know the difference between insolvency and illiquidity and design your buffer accordingly. The FDIC's failure mode for you personally is almost never permanent loss. It is temporary inaccessibility. The scenario that destroys businesses and financial plans is not the scenario where you lose money. It is the scenario where money that you know you will eventually recover is unavailable for 60, 90, or 120 days at a moment when you needed it on day 10. The buffer against this is not complicated. It is knowing exactly how much cash you need to be continuously liquid for 90 days under a stress scenario, and making sure that specific amount is structured in a way that puts it beyond any realistic disruption. Everything else is a question of return optimization, not survival planning. Lazy investing built more fortune than crypto memes. The FDIC is an extraordinarily well-functioning institution for what it was designed to do. It has maintained the confidence of the American banking system for nearly a century. Not one depositor has lost a penny of insured funds since 1934. That is an extraordinary track record. The coverage ratio problem is not a condemnation of the FDIC. It is a description of the structural gap between what the institution promises and what the math can deliver in a sufficiently severe scenario. That gap is filled, ultimately, by a political decision made under pressure, by people who are trying to avoid the appearance of a bailout while also trying to prevent a financial collapse. You should know what the gap is, and then you should build your financial life so that you never have to care whether the phone call to the Treasury happened before your Tuesday payroll.